We're very pleased to announce the best return that Mansa-X has actually ever delivered, at least for the Kenya Shilling Fund, quarter on quarter. We had the best quarterly return that the fund has ever delivered since we started running this fund. So for quarter two of this year, the Kenya Shilling Fund returned 6.05%, which on brings the half-yearly number to about 10.94%, annualizes to about 21.88%. So this is a number that we are quite excited about, and we hope that our investors will be just as excited about it. For the dollar fund, the return was 3.47% for Q2 of this year. That's a half-yearly return of about 6.61, annualizes again to about 13.22%. And we're very pleased about these figures. They are also reported net of our fees, and again, from a tax perspective, you also have them tax exempt. So we hope that our investors will be very excited about this. In terms of assets under management, the growth was also quite impressive, and we are very happy to onboard new clients. We've onboarded about 7,200 new investors into the fund, from about 27.8 thousand investors to about 35,000 investors at the end of Q2. That represents a growth of about 25.5% in terms of the number of investors who've actually joined the fund. We're very happy about this, and we want to welcome the new investors. This has also pushed our aggregate assets under management from about 55 billion to about 75 billion assets under management. We're very pleased about this because it goes to demonstrate that investors are actually looking for funds that will not only give them better than average returns, but will also ensure genuine diversification. And we expect that the fund will continue to grow. And we really are happy with our investors who have continued to believe in us. We entered the second quarter of this year with a lot of anxiety, and I think I mentioned this in my last YouTube video. We had a lot of anxiety around the tariffs that were announced by the new Trump administration. So, in fact, as we entered into Q2 on the 2nd of April, we had something called the Liberation Day tariffs, and it had a very serious impact on markets. So fund managers, such as ourselves, went into the markets with a lot of caution. And for sure, we actually saw markets lose as much as almost 20% during that period of anxiety and concern around tariffs. But then again, within about 2 weeks after the Liberation Day tariffs announcement, the same Donald Trump administration announced a pause on these tariffs. So now this pause again shifted the sentiment for markets, and markets rallied, in fact, to all-time highs, again closing at almost 27% higher than where we were actually when we had lost value. So just demonstrates to you how policy shifts and around tariffs can actually influence volatility, and this fund is actually able to take advantage of that, because you had losing markets and then the same markets shifting to very positive within a period of less than 2 months. It demonstrates to you how volatility in these markets can be very beneficial actually to a fund like ours, because when you're trading using a long-short trading model, those kind of shifts actually can create a lot of return for you as a fund manager. In the US, inflation remained low, close to the 2% target. But again, the Fed remained still very cautious. They didn't do much during that period. In fact, we saw no adjustments to the interest rates in the United States for the second quarter of this year. Again, the Fed also wanted to see the impact of this volatility that is induced by tariffs, the tariffs policy of the new administration. We expect that kind of cautiousness from the Fed to continue even into Q3. Another thing that was had an impact on markets in Q2 was the geopolitical escalations, the conflict between Israel and Iran for one, that actually caused, again, some sort of volatility in commodities. We saw oil spike during that period by about 7%, although on a quarter-on-quarter basis, oil actually lost value during that period. But again, that was induced a lot of volatility in commodities during that period. We also saw a lot of interest in defense stocks during that period, and this is one of the stocks that we own within Mansa-X, and have continued to add to the performance of the fund. Gold and silver gained during periods of volatility. Gold and silver tend to gain value because they are a flight to safety. So gold and silver gained about 6% each, and again, this is one of the assets that we were holding in the fund. The dollar globally lost against most currencies. In fact, the dollar index was down 10% quarter on quarter, and this meant that there was a sort of like a rotation away from the dollar into other currencies like the euro and the Swiss franc. And even locally, we saw the Kenya shilling actually remain quite stable against the dollar in spite of local dynamics. And we expect for now this to continue. Locally, we actually saw the local stock market gain about 17% quarter on quarter. And that was actually very exciting to see because one of the things we have to be clear about is that Mansa-X also holds local stocks. So we don't just hold foreign stocks. So even for us, we benefited quite a bit by being invested in the local market. And we continue to see excitement and optimism in the local market. We are seeing some listings coming up, like what we saw with the Talanta bond. And we are also seeing the new company that was listed yesterday, the packaging company. So we are actually seeing some interest now in the local stock market. One of the effects of the dollar losing value is actually some sort of, and even concerns around the tariffs coming from the United States, is some sort of capital rotation into Europe. So that creates a very interesting environment for the policymakers in Europe. And we saw them reacting to this by cutting interest rates, which is how they then protect their currencies being becoming too affected by that capital rotation. So we saw the ECB actually reduce interest rates from 2.5% to 2%. We saw the Bank of England cut rates from 4.5% to 4.25%. The most interesting one was the Swiss National Bank, who actually cut their rates from 0.25% to 0%. So you actually have a zero interest rate environment in Switzerland now. The reason for this, again, is just to really, because what happens, you can quickly have your currencies gain value too quickly, which can actually affect your ability to gain the same returns from your exports as you were before. So essentially, that's how policymakers protect their countries by cutting interest rates in the manner that is happening now on the European continent. So it was a very interesting quarter, but in summary, we saw volatility induced by tariffs, but then again, optimism being injected into the markets when these tariffs were posed. So that's a key thing, and that's a key takeaway for investors to understand how markets, in spite of all this, actually tended to be positive, and how funds like ours actually ended up making money from this. So we had a market that actually ended up being a lot more positive. It's almost like you started with a lot of fear, only for that fear to be downplayed so significantly that it now turned into a more optimistic quarter. And that really is how the fund ended up having one of the best quarters we've ever had. And then, of course, some of the geopolitical tensions that we had, like I mentioned, again induced a growth in companies that we are very heavily invested in, and also created opportunities around taking advantage of the move in commodities. That's a brief summary of it, but just to also advise our investors to be reading our global markets review, where we actually give you a complete breakdown of exactly how the fund was invested during that period of the 3-month period of Q2. So you're able to understand much better how the fund actually made the returns that it made and what assets were actually invested in the fund. So now on to the top 10 holdings for Q2 of this year. And this information is contained in the fact sheet that we distribute to our investors every quarter. We usually give you details about the fund. We give you the fund description. We give you a summary of the fund manager comments. And if you can find time to read this, it also gives you an idea of the dynamics that allowed us to make the return for you in that quarter. It also gives you who our service providers are and the regulators. And just to quickly give you an overview, the umbrella fund manager for this fund is Standard Investment Trust Funds. And I will explain to you later why this is the case. Our trustee is Kingsland Court Trustees. We are regulated by the Capital Markets Authority. Our custodian is I&M Bank. And our auditors are Charterfy LLP. So on to the top 10 holdings. And again, the top 10 holdings refers to asset classes that in terms of allocation found themselves in, at the top 10, not the performance. So we don't necessarily mean that these were the highest performing assets and that's why they are in the top 10. We mean that in terms of their proportion to the fund, they constituted the top 10 holdings. But at any one time, we have sometimes up to 200 other assets, because for something to qualify to be in the top 10, it typically would have to comprise of over 1.5% of the fund. We have hundreds of others that constitute, sometimes we're just maybe 0.05 or 0.1% of the fund. So we have a much longer list of asset classes, but these are the ones that fall in the top 10. So the first largest holding in the fund was fixed income instruments. Fixed income instruments refers to government debt mostly that we hold in the fund. We trade in African Euro bonds, we trade in US treasuries, German bonds, essentially fixed income instruments from around the world. Then we usually use interest rate derivatives to hedge this exposure again, because of course interest rates are also quite volatile and will continue to be quite volatile, so we hedge them out using interest rate derivatives, and that's why those two tend to move in tandem as a pair. So interest rate derivatives again becomes the second holding in the fund. So in Q2, as I mentioned earlier, due to the geopolitical tensions ignited by the Israel-Iran conflict, we saw a lot of opportunity to trade crude oil. So in June, specifically, we saw crude oil gain as much as 27% that month alone. Even if at the end of that month, that is June, the gain was only 7%. And then that value again was lost the entire quarter. We closed at, it was actually lower than where we started the quarter, down 7.9%. This is very interesting for investors to see how one asset class can actually gain value and lose value in the same quarter, and in that one particular instance, allow a multi-asset strategy, long-short fund to actually make a return as the asset gains in value and it actually loses in value. One asset class can actually make you returns both ways. So we essentially were able to trade crude oil when it's rising in value, and again traded it down as it lost value. So when we talk about diversification is also just the long-short trading model. One asset class can actually be traded two different directions and make a return. Our fourth largest holding was actually Netflix. Netflix gained about 43.6% in Q2. Netflix is one of those companies that is not affected by tariffs, because you can't impose tariffs on a subscription-based model company like this, and neither can you also have retaliatory tariffs on it. So we saw the company the stock gain about 43.6%. Oracle, one of the companies that's actually benefiting from the AI wave. They're onboarding more clients and charging more to create AI-enhanced solutions, gained about 56% in Q2. NVIDIA continues to be one of our favorite holdings. Again, the AI wave and also what's happening in the cryptocurrency space keeps NVIDIA very attractive for investors, and their revenues have continued to grow significantly. NVIDIA gained about 45%. BAE Systems, as a defense contractor, because of the geopolitical tensions that we've mentioned, gained about 21% in Q2, and it was our seventh largest holding. Gold, like I mentioned earlier, because of flight to safety, gold gained almost 6% in Q2. And this remains one of the asset classes that we hold whenever there's volatility. Gold and silver tend to gain. Our ninth largest holding was Microsoft Corporation, which gained about 32% during that quarter. Then we also hold quite a bit of cash and cash equivalents. The reason we do this is because maintaining liquidity in the fund is very important to us, so that we have the ability to pay investors as and when they require their funds. Actually means that at any one time we have to hold cash. So in a sense, it's an asset, because obviously there's also some sort of remuneration we get from our bankers when we hold cash with them. And therefore it was actually our 10th largest holding. Now this was for the Kenya Shilling Fund. The assets I've mentioned. For the Dollar Fund, not too different. The only reason why sometimes the top 10 holdings can be different for the Dollar Fund is because of when you actually initiated the trade. So sometimes if you initiate a trade later than when you initiated for the other fund, it might be better to buy another asset class. So for example, if we were looking to get into defense stocks in the Kenya Shilling Fund, and then we get into defense stocks for the Dollar Fund, 3 days later, there might be another defense stock that might be better for that fund on that day. So if you look, you'll see similar kind of companies, but some might be different. So like for the Kenya Shilling Fund, we have BAE Systems as a defense contractor. For the Dollar Fund, we have Raytheon, RTX Corporation, as the defense contractor. So similar strategy, but the companies can differ. Then you'll notice, like for the Kenya Shilling Fund, gold futures gaining prominence there at a number 8 holding, but for the Dollar Fund, having silver futures again as the dominant precious metal. So the only other thing you'll notice in the Dollar Fund is a 9th largest holding, which is Vistra Corp. This is one of the strategies that have paid off for the fund. Like Vistra Corp is a nuclear energy company that gained about 65% quarter on quarter. So that's a phenomenal growth. We are seeing a lot of demand for energy now, and clean energy. And this is mostly also being driven by AI companies that are using so much energy that nuclear companies are actually now getting more and more contracts to provide energy for tech companies who are heavily involved in AI. In fact, we are actually seeing some companies actually looking to contract nuclear companies to set up their own nuclear energy plants purely because of their AI requirements. That's how big the nuclear energy sector is going to become as AI gains in prominence, and also again cryptocurrencies, because those two are very energy heavy industries. So we'll continue to see a lot more prominence within our fund, where we buy. It becomes a very good proxy outside of buying cheap companies as a proxy for being in the AI business, and even just buying AI businesses directly. Buying energy companies becomes one of the strategies that we'll continue to use within the fund. So that's our top 10 holdings of the fund. Again, this is contained in your fact sheet, and it helps our investors to see where we were actually invested in. One of the other things we also show in our fact sheet is the geographical distribution of these assets. The Americas for the Shilling Fund remains the biggest location of our assets. Most of our assets are in the Americas. About 45% of the fund is invested there. Next largest is Africa, about 31%. So we haven't really left our continent that much. And then the European continent, about 16%, then Middle East, Asia, and Oceania region, the rest. For the dollar fund, we have the distribution mostly in the Americas, the Europe coming second, then Africa third, and then for obvious reasons, because this now is a dollar-denominated fund, and then Middle East, Asia, and Oceania come fourth and fifth. We are going into the second half of the year with very similar themes like we did in the first half of the year. So we are still looking out for tariffs and how this works out. We're still looking for geopolitical tensions and how they'll affect defense stocks. We'll still be closely monitoring the AI space, and again, its impact on not just tech companies, but other related sectors. So moving into the first half of the year, the second half of the year, one of the things we'll be looking at is tariffs. So the tariffs pause had been postponed to the 9th of July. This was again pushed to the 1st of August, but markets are still optimistic because there seems to have been, there's now clearly room for negotiations on these tariffs. In fact, as recently as some weeks ago, we saw Japan has already cut a deal with the US, so has the EU. So markets are still up. If you look at the S&P, we are still up almost 8% for the year. This is expected to continue. Another thing that is interesting to watch in the second half of this year is earnings. Earnings have been very strong. In fact, in the first half of this year, we saw over 78% of the companies actually beat earnings, and we actually expect over 90% to actually beat earnings even moving into the second half of this year. So this is not just for the US market, it's also for companies that are actually domiciled outside the US. The other thing that we'll be looking at in the second half of this year is inflation. We had a lot of concerns around inflation when we started this year because we felt that tariffs were actually really going to create runaway inflation, and this has actually not happened, and it will be very interesting to see how the Fed reacts to this. We didn't see any action from them in the first half of this year. It will be interesting to see whether they will probably, maybe cut interest rates in the second half of this year due to the fact that we've seen inflation has remained close to the target level of around 2%. It will also be very interesting to then see the relationship between Donald Trump and the Federal Reserve Chair Powell, because there's been a bit of conflict there, but now there seems to have been a stabilization of that relationship, and we'll see whether this will lead to a difference in how the Fed approaches monetary policy. Another interesting thing to see is that the tax cuts that Donald Trump implemented in 2017 have now also been made permanent. So it will also be interesting to see how this will affect company earnings moving into the second half of this year. Locally, we still think that the Kenya shilling will remain stable against the dollar. We don't expect much movement there. We expect that local fixed income securities will actually see interest rates coming off. We have already seen interest rates drop significantly. We expect this to continue. We saw the CBK cut rates, the key monetary policy lending rate, to 9.75%. We expect more cuts, especially because the private sector growth has actually been very subdued. So it's very likely that the CBK will want to reduce interest rates further to try and spur this. Looking again at the effect of AI, just to go back to that, we expect that there'll be a lot of AI-led market behavior in the second half of this year, as we saw in the first half. The only thing is that we expect it to now start becoming more influential on other sectors, not just the tech sector. In the first half of this year, we saw AI push tech stocks to grow by over 36%. But now we will be looking at how AI influences sectors like data centers, energy production companies, like I mentioned earlier, like nuclear farms, and infrastructure themselves, because you also need to create a lot of data centers, and these require infrastructure. So AI and its dominance will now start affecting other sectors in a positive way. Defense spending, we also expect, will boost defense companies globally. We have seen recently NATO countries agreeing to incrementally increase their defense spending to up to 5% of their GDP. That's quite significant because the current average is about 1% of GDP. So we expect that defense companies will actually see significant growth in the second half of this year. So these are companies we'll continue to be looking at very keenly as we move into the second half. So we still expect that moving forward, it's going to be a very exciting time. We expect earnings will be high. We expect new interesting areas where gains can be had, and we expect that the markets will most likely actually shift to be very risk on. And because of that, that will also lift emerging and frontier markets. We expect our local stock market again to be pushed up by that risk-on attitude. So we expect the local NSE to continue to gain moving forward into the second half of this year. And we also expect that our Eurobonds will actually gain value. They tend to be very much linked to the attitude and risk-on sentiment of international investors. So we expect that Eurobonds will continue to gain value moving forward into the rest of this year. It's always, it's of course, you can't really predict the future. You can only reasonably look at what is going on and see how you will adjust your portfolio moving forward to make sure you have a return. But the advantage we have, like I always mention, is that Mansa-X is so well diversified that we are able to take advantage of all these shifting dynamics as and when they happen to the benefit of our investors. So no matter what happens, we're still confident that our model continues to be the kind of model that will give a return that will exceed investor expectations and will beat what the market average is out there. We've had some investors asking us why it's called the Mansa-X Special Fund as opposed to what it used to be called before, the Mansa-X Fund. So the CMA created a new category of collective investment schemes called special funds. The idea here is funds that have, a bit of a unique investment approach to markets, essentially alternative funds in the market get that tag called a special fund. So Mansa-X is one of them, and Mansa-X is actually domiciled under what you call the Standard Investment Trust Funds. So that's an umbrella fund. I mean, it's the umbrella entity that owns the Mansa-X fund. So you have the Mansa-X Kenya Shilling Special Fund, you have the Mansa-X Dollar Special Fund, Mansa-X Sharia Special Fund, Dollar, and Kenya Shilling. So you have 4 of them in that sequence. And this allows the funds to also enjoy benefits. So one of the first ones is when you're delinked to SIB, we are able to protect the assets of the investors better, because now you're within an entity that's specifically only holding the assets of the investors. So we don't commingle the assets of Standard Investment Bank with the assets of our investors. That creates further protection for our investors. The other thing is that we are able to get tax benefits within that entity called the Standard Investment Trust Funds, which then is transmitted to the funds that we manage under that umbrella fund. So very recently we got our tax exemption as a collective investment scheme under the SITF. So this allows our investors, when they receive distributions from us, distribution means the share of the profits that the fund is making, they actually do not have to pay tax on that. They get a tax exemption. This is one of the biggest benefits for our investors, both retail and corporate, because of creating the umbrella fund and putting them under the tag of the special funds. So anyone who needs to really understand this further can always reach out to their financial advisor for more details. And of course, one of the things we always say, even when it comes to things like taxes, they can be very personal to everyone, and it's always important, if you have very technical questions, to make sure that you're running them by your tax advisors. Another question that investors have asked us is, where is my... Okay, for some investors, so not everyone, obviously. So sometimes some investors will say, my return does not quite match what you reported. Why is that the case? So when we talk about fund performance, we talk about it within a specific period. So if we talk about Q2 performance, we are obviously talking about from the beginning of the quarter to the end of the quarter. For the investors who came within or during that quarter, say you came in the middle of that quarter, the performance could have been either better or worse than the entire quarter. What do I mean by this? The fund is a market-determined return. So it's not, we don't invest in an interest rate product where you take an interest rate X and divide it by 365 and that figure is what you get per day. It's actually what you're trading in markets on a daily basis. Some stocks go up or down on a daily basis and so on. But at the beginning and the end, how you started versus where you end is what we call the performance for the quarter. So that's one of the reasons why we really encourage our investors to comply with the lock-in period for the fund, which is 6 months, because then you are able to have a full and a little bit more of a holistic understanding of how your return actually was. In fact, I would really encourage our investors, if you don't really need the funds immediately, a 1-year period investment is even much better, because then that would wholly align with how the fund has performed during that period. But if you're in and out, maybe in between quarters, you might get either a better performance or you might miss out on some performance if you keep withdrawing in between. So the key thing to take away there is to remember that Mansa-X is a market-determined fund, but over time, the return will always be as we announce it to be. And we've noticed, of course, the investors who get a better return are a bit quiet than the ones who maybe did not get a better return than the fund. This is natural, but what we are saying is please align with the lock-in period, and over time you'll find that your returns will make a lot more sense to you. If you don't understand, obviously, that any of the numbers that you receive from us on a quarterly basis, again, you can always reach out to us and we'll explain it more. Finally, I'll take this opportunity to thank our investors. We are continually humbled and honored by the faith and trust you place with us. We are now essentially in our 7th year of running Mansa-X, and during that period, we've seen some of our investors stay with us for not only that period, but also refer business to us and also top up the investments with us. Some started slowly and have grown to significant portfolios during that period. So we are very appreciative of the faith and trust you place with us, and we don't take that for granted. We are very committed in how we run this fund, very committed to making sure that not only do you get a good return, but that we protect you from the downside risks that come from participating in markets. This is very important to us. This hasn't changed, and we're always looking for new ways to even protect you further while still generating an above average return. So that's called creating alpha, where we try as much as we can to reduce risk while still keeping the return elevated. So moving forward, we just want to assure our investors that this approach to investing will continue, and that we will also continuously look forward to having more conversations like this with our investors and giving them better numbers moving forward. We were very happy about the attendance of our last AGM. and we will continue holding AGMs with our investors so that we can engage with you. One of the feedback we got last time is that our investors wanted to spend more time asking us questions, so we will change the structure of our AGM next time to accommodate a lot more question and answer session from our investors. So thank you very much.